name's Ken Skornia, President and CEO of Krilogy. Here with my partner, John McArthur, Chief Investment Officer here at Krilogy. And this is your November market perspective. Man, it's been a quick month, John.
It has.
We sat here late in the summer. I think I said this in the last video in October, which was, what'd you think for the rest of the year? And you said volatility. Market goes down 10. November, it's been up 10. Here we are riding the roller coaster.
Yeah.
What's your thoughts?
So, yes, as we kind of embark on the last month here, you said it, peak in July, pretty orderly sell-off of about 10%, a little bit more than that in the S&P. And then we've made, most of that back. I think really the catalyst is the market seeing data that suggests the Fed's done. And that's been the overhang for some time. How many more rate hikes? I think the rollover in inflationary data for the most part is suggestive that the Fed's done. In addition to that, there's signs of an economy that's waning a little bit.
Yeah.
You see a consumer that is pulling back. Pricing pressure for corporations is waning in kind of a disinflationary trend that's transpiring. You're seeing credit harder to come by, delinquencies rising, unemployment, ticking up. So there's some cracks in the armor, I think, that are starting to show that would also suggest that the Fed is done. I think the key to this next phase is the whole higher for longer narrative with respect to rates, likely or not. And the bond market the markets in general, I think, are suggesting no. In fact, there's over a 50% chance of a cut in March.
Which is almost hard to believe compared to what we've had the conversations over the last year or so. The Fed is great about coming up with nice little sayings, right? Soft landing. Have they figured out a way to create this soft landing? And is this the new normal?
Right, the new normal, transitory for inflation and higher for longer.
Do you think they've figured out a way to create the soft landing for this economy?
I don't think so. Our belief is that a recession is inevitability. Of course, at some point in time, it's you're right, eventually. But I think as we get in, when we get into 2024, we're 19, 20 months, very much within the normal window of lag effects from what's been the most historic policy increases ever from the Fed. So it's very normal to start to see those cracks show up in the economy. And I think what's more likely than not is the stagnation period. It doesn't mean an awful recession and a complete rollover of markets. I think it does mean that meaningful upside in returns from here are a lot harder as we look at valuations, as we look at policy. I think really the catalyst for this rise in the last month, which has been really sharp, is kind of some of the key tenets that we've talked about in the past, which is a rollover in rates. 10-year went from 5 to 4.25 really quickly. So a compression of yields. We've seen the dollar soften, and conditions have eased. And that was a catalyst for risk assets. Many were very offsides from a positioning perspective, underweight equities. And so that's kind of evened itself out now. I think now, on a go forward, I think we want rates to stabilize because a continuation of a deterioration in yields is suggestive that a much weaker economy is in store.
Absolutely. And they're seeing something that we're not seeing.
That's right. And that would be this potentially next phase is a growth scare where a further decline in yields of substance would not be great for equities, inevitably.
So the bond market, by the way, has had a nice little rally in the last 4 weeks. You spoke about that late in the summer, that there's opportunity there in the bond market.
And it happened really fast. And we talked about, positioning and really dollar cost averaging in fixed income, similar to how you think about equities, because when it happens fast, and you're either positioned for it or you're not.
Right.
Now we're in a situation, those that were not participating in duration from a fixed income perspective. So, going out beyond cash rates, 1 and 2 year CDs and treasuries, and recognizing value in committing to those higher yields for longer term periods, is really advantageous because, again, prices go up as yields fall, and they've fallen really fast. And so it's a dilemma now. Do you enter now if you haven't lengthened duration, or do you wait for some kind of, normal retracing of the move we've had, which is probably likely at this point?
It's interesting you compare trading and managing money in the fixed income market, comparing that to the equity markets, because for years, all we saw was interest rate drops.
Right.
And there wasn't a lot of money management happening inside the fixed income world. Now with some volatility in there is opportunity to create capital appreciation in a fixed income market that most people don't normally try to take advantage of.
It's a great point. And the dynamic nature of fixed income and the different segments of fixed income that you can invest in lends itself to really thinking about alpha generation opportunities, and within equities. There's been so many dislocations. It lends itself to an active management component that can really drive alpha. And again, true in both segments, equity and bonds, where, I would argue that, the beta trade, just taking, S&P 500 risk, for example, in equities, or aggregate bond market index exposure on the fixed income side is probably suboptimal, because of the dislocations on both sides.
Talk to me about indexing versus active management, because I think, for a long period of time, the set it and forget it theory works really well. And if you're a really long-term investor, 15, 20-year investor, it tends to work out really well. It takes a lot of stress off in terms of how are you going to create excess return, which is what you're referring to as alpha. Compare that to someone who is trying to get that excess return over the next 5 to 7 to 10 years. It's a different way of managing.
It is. I think there's a couple points of emphasis there, and there is a middle ground. I think you can really marry the benefits of active and passive active and passive investing. A lot of what we do on the portfolio construction and management side of things is the ongoing tactical management aspect of it. So think of it as steering the ship. There aren't significant changes of direction. We're really, just making some changes around the periphery of a core allocation, of course, depending on risk. And with respect to implementation, active and passive, think of, an example would be small caps. Small caps have been largely out of favor for a number of years, relative to large cap especially, but also relative to their past, or to themselves, on a 5-year basis, has essentially gone nowhere. But, if you peel back the onion there, we recognize that 35-40% of that index is non-profitable, which doesn't lend itself to doing well in a higher rate environment. So, an example in that space is we've got a focus in small cap value on quality, and you're participating in businesses that are profitable. Yes, they're small cap, but there's significant differentiation in price. We've got 600 basis point spreads, between a quality value, profitable vehicle versus, just owning a beta play on small caps at the index level.
And I think what your team is doing for our advisors, and then therefore the clients of Krilogy, is really putting massive effort towards those sort of tactical plays inside those different asset classes. The old set and forget it model is over. With the ease of money sitting out there is gone. If you're running a large company, or even a small mid-sized company, you have to figure out where to get capital from. You need capital to grow.
Absolutely.
And capital is expensive. So you need to find the best run companies.
Absolutely.
Doing the most work in creating the best cash flow.
Especially in this environment. You bet.
Okay, so what else are you seeing from your team out there? I know Jamie Satley sent out a message to, he sent a message out to the rest of the firm saying, if you're under the age of 50, this is one of the best Novembers you've ever seen. In terms of market return. What else is your team saying?
I think that's an indication of sticking to the core plan. It's easy to have let the emotional slow deterioration in markets from, peak in July, August, September, October, 3 negative months in a row. That hasn't happened in a long time. And, so sticking to the plan, of course, to be able to participate in the upside that we've seen. Again, we think that the going forward is much tougher. Easier to say that, of course, after a 10% move.
Right.
In markets, but part of the challenge obviously relates to Fed policy here too. What Chairman Powell spoke about in November was the tightening of financial conditions from higher rates, stronger dollar, lower market can do some of the work for the Fed. That's changed. That dynamic has changed.
Right.
And he actually speaks tomorrow, and then a Fed meeting here in a couple weeks. But it'll be interesting. It would be suggestive to me that the market is overly ambitious about a 50% chance a cut in March. I think if they're cutting, they're doing so for evidence of recessionary conditions setting in. So
yeah, exactly.
This for us is really time spent on forecasting. Jake Thornton on our team has done a terrific job of modeling out our process in that regard. We had a 4,300 base case last year, which was interesting at that time, was really bullish relative to consensus at about 4,000 on the S&P, exiting a really tough 2022. So we'll see where we end up. That's just kind of a fun game for us, I think, more than anything else. But we've got a month left. We'll see where things end. But we're getting into the period where we're starting to look at 24 and looking at opportunities, really digging into expected returns in different segments of the portfolio and asset classes. And that's really important because I think this next multi-year horizon is really about alpha generation from a portfolio construction, and doing what worked in the past, just taking, market beta is going to be tougher.
It's going to be tougher. And I think, when you have news such as, the geopolitical challenges that are going on in the world today, our own economic conditions, but, the U.S.'s economy is not the same economy that's happening in Europe.
Without a doubt.
Happening in Asia.
Absolutely right.
There's a lot of different things happening, but what the financial news loves about this time is that there's all kinds of crazy headlines that they can pontificate on.
Absolutely.
Both the bear market,
you bet,
the bears and the bulls.
Yeah.
You see different analysts come out so far on some of the biggest research firms out there saying S&P could be over 5,000 next year.
Right.
And then the next segment could have someone talking about the S&P.
You bet.
At 4,100.
You bet. And interesting on the
creates great news.
It does.
Creates great TV.
The math around the 5,000 is interesting. I mean, it's $250 of earnings on the S&P at a 20 multiple for next year. And the challenge is that assumes a meaningful amount of earnings growth.
Right.
And, we're seeing a stalling of revenue growth for companies. We're seeing potentially peak profit margins. There's still some cost cutting. The cost cutting is, by the way, has to continue to be a factor in order to meet that goal. It's possible, and no one has a crystal ball, but assessing along the way and working really around probabilities is important, because no one knows what.
For the market to hit a number over 5,000 on the S&P,
mm-hmm.
I think you need to have some sort of stability in rates so that managers of companies can create some real CapEx spending.
Without question.
But there has to be some predictability over the next couple of years to see where that goes.
Absolutely right.
Yeah. So what else are you all seeing on the fixed income side? What do you see over the next
fixed income? We've
rest
seen
of the year through the end of the quarter next year?
We've seen a nice move, as you touched on, in yields declining, prices rallying. We're seeing an uninversion of the yield curve, which is historically more of a preceding indicator of an eventual recession. As the yield curve normalizes, short rates are coming down. Intermediate term rates, longer rates have come down a little bit as well. But you're seeing that normalization because we've been inverted here for a long time. So it just lends itself.
With Paul Gabriel, our head of capital markets,
has talked a lot about.
Spoke a lot about it. I think I joked, most bond professionals aren't the most bullish people on earth.
Right.
We were in an investment committee one day, and I turned to Paul. I said, Paul, it sounds like you're a bull. You know, and here we are. You know, the market, the bond market takes a snapback on us.
It sure
in
has.
a positive way. So.
Still good opportunity.
What are you saying to our clients who, you know, came into some liquidity with, you know, maybe the sale of a practice or a business, and are trying to figure out how to get into the market? Obviously, you can put a lot of money into cash and get some decent yield on there, but at some point, you're going to have to, you know, step onto the dance floor. What are you advising the clients in that space?
That's a foray into tax reduction strategies for, you know, concentrated equity positions, business exits. There are really terrific solutions from the investment implementation side of things to help lower that tax bill. It's nice having a robust tax team like we do, of course, on staff to help work through those moments. But I think there's been a significant evolution in the wealth management space at the retail level that had really only existed much further upstream, large family offices, et cetera. So the accessibility of some of these strategies to, to not only have a successful investment outcome, but reduce the tax burden
capital gains tax on the
absolutely.
I was just in Dallas having a dinner with a client on Tuesday night who's on the verge of exiting their company. And, it's interesting. You spend, at this point, this gentleman had 18 years into this organization. Is going to walk away with a sizable lump sum, but it all comes down to taxes.
The tax piece is
it's not the return, it's the taxes.
Absolutely.
And as you say, there's opportunities out there today in the marketplace that I know you and your team are doing a lot of research on to find ways to mitigate those taxes, at least in the first year or so.
Absolutely right.
So anything else out there before we wrap up?
No, I think that's those are the key highlights. Sticking to your plan, again, assuming you have one, really focusing on expected returns and being realistic about returns and what you pay for those return streams and where you go to get them.
That's great. Well, thank you very much. Always a pleasure.
It's fun.
Looking forward to see how this, 2023 ends up through the month of December. And thank you all for allowing us to be stewards of your wealth. And as always, if you have any questions or want to have a conversation, please contact your wealth advisor here at Krilogy. And for John McArthur, I'm Ken Skornia. Have a great day, and we'll talk to you soon.